Welcome everybody to AMA number 13. That means it's been over a year since I've been doing these, and I know many of you guys have been here since the beginning, so welcome. Thank you for sticking around and showing up for one of these where you're here live or you're watching the recording. I know most of you guys watch the recordings. If you're watching one of those recordings because the time doesn't work for you, I have an announcement to make. Last month, I said that this was going to be my last recording with this background, but plans changed, and instead of moving to Barcelona, where I intended to move, me and my wife, we're actually going to move to Colombia. We have a house there. We actually have two properties there. We're going to be moving to Colombia. I'm going to be fitting one of the rooms, going to make it into my office, and that means I'm probably going to do some polling on what the best times are, and I may just shuffle things around. We might do some of these in the afternoon. We might do some of these in the morning. And I know this because those of you who know Brett Fogel, a good friend of mine, we started doing this together initially. We might be doing more things in the future, by the way, but stay tuned for that. We haven't actually discussed anything formal yet. Um, but he's the one who said you shouldn't do these early in the morning because many people can't show up. And I kind of agree. I think the ideal time for these would be market close, 4 p.m. Eastern. That would be the ideal time. In Colombia and Medellin, I may have to do 5 p.m. Eastern. I'm probably going to be doing these by then. Let me know if that works or not. I'm going to do a poll to see what works, but I'm pretty sure that for most people, maybe not for you, Marcos. I don't know. You let me know because you're in Australia. But I'm gonna try and find a better time or just mix it up. I know that the good guys at Global Macro Investor, they try to hold AMAs for us, the subscribers. There's like 300 of us. It's a very small file, and they usually just shift things around so that people can join at different times. So I'm working on that. I'm thinking about that. You can catch these. You can catch the bulk of some interesting segments on YouTube also. I'm probably gonna start putting these on YouTube. It's a lot of stuff going on, guys. Probably gonna start putting the AMAs on YouTube itself so that people can watch there. But the number one reason actually for that is because Zoom wants me to pay for storing videos, whereas YouTube is the hosting is free. And so it's like, why do I have these on Zoom when nobody can see them except for you guys in Discord when I can just put it out on YouTube? Now, the reason it wasn't on YouTube is I never sit through a 3 hour, 2.5 hour long live stream. Like, never. I don't have the time. So I thought, who's going to watch this? Well, maybe some of you will. So it's going to be probably on YouTube, where I'm not being asked to pay for hosting videos. So that's that as far as announcements go. I think if I forget something, then you can just ask me. I'm near Malaga today, but yeah, normally Australian markets. Oh, you're in Malaga, sir. Well, it's beautiful this time of the year. I was in Malaga a couple of weeks ago. It was beautiful there. I was just in Mallorca actually until 3 days ago. So we're going to Paris over the weekend. Not excited about Paris at all. But my what do you call it? Like my father-in-law wants to go there. So I was like, okay, fine, I'll take you to Paris. Uh yeah, it's tourist land. I'd rather stay here or go somewhere in Spain. Anyway, so apparently Jay is talking. So let's dive right into it. As always, I'm going to start with where I see the market because people ask that all the time. And okay, so here's my thoughts on the market, and this section will probably go straight to YouTube too. Um, so what are my thoughts on the market? Liquidity. I've been in love with this indicator since I found it. Like I love this thing. It tracks so well with crypto. It's fascinating. And I don't know which one of you guys pointed it out. I don't know if you're here, but one of our great members pointed out that even this sell-off on Bitcoin was kind of being mirrored by liquidity. So this, I don't know if I think you can see it, right? Like if I do this, you can see how even this little sell-off, you can see it here. You can see it right here. And I did notice that little wiggle in the chart. And I thought, nah, there's no way uh, global liquidity or central bank liquidity moved forward by 84 days, which is like voodoo. It's magic. Why 84 days? Why does it work? I did point out that there are some orbits that line up with this specific time frame, and the reason I think it's interesting and weird is because I have seen the same multiples of 84 days work with gold and Bitcoin. I actually have a whole issue written on that, and if you want to know about that, I'll show you here. Now the indicator is not as so gold. Just the TLDR is gold is a forward-looking indicator for where Bitcoin is going to be, not in 84 days or 12 weeks, but rather 24 weeks. So it's 24 weeks, and it's a forward-looking indicator too. But when I looked into the history of this relationship between the 24-week leading time for gold versus Bitcoin, I noticed that in 2011 and 2012, and going through, I believe it was through 2018, so the first 8 years of Bitcoin trading history. And get this, because this makes no sense. Bitcoin was leading gold. It was leading gold by 12 weeks. So this number, 12 weeks, 24 weeks is a multiple, or as they used to say, a harmonic. Gann, legends like Gann used to say a harmonic. So 24 weeks is a multiple or a harmonic of 12. I think Gann wrote a book called The Square of 12, even. He even said that the number 12 is very important. Now, the reason I'm pointing this out is because I don't think it's the conventional explanation is gold is a forward-looking indicator for liquidity because gold traders are super smart and they just know what liquidity is going to do. They know what the central bankers are going to do before the central bankers themselves know what they're going to do. That's how smart gold traders are. That's a conventional explanation. Then you have liquidity, which is like what the central bankers are going to do. And then you have Bitcoin, which trails behind liquidity itself. So you have gold pricing forward liquidity in 12 weeks into the future. Then you have the actual liquidity moving. Let's say that's moment zero. And then moment minus 12 weeks or 3 months. Well, that's Bitcoin reacting to that liquidity. So gold forecasts it, liquidity reacts, and then Bitcoin reacts to liquidity. And so there's this relationship of 6 months between Bitcoin and liquidity. And of course, about 3 months between liquidity and gold. Although that correlation is not super strong. I've tested it. It's not that great, which makes no sense, right? I mean, if gold leads Bitcoin by 24 weeks and liquidity leads by 12 weeks, logic would dictate that gold leads liquidity by 12 weeks. And it kind of does, but not really. If you want, I can waste your time with that today, but it's a waste of time. I looked into it. There's nothing to it. Alex is pointing out that crypto's moving fast. Yeah, man, because it's Jay Powell, but I do want to talk about that. I think that's key because it's crucial because we're going to get a sense of what's going to happen now because notice that this dip on this chart, and I'm going to line them up pretty quickly here. I'm going to line these up, but notice that it was kind of forecasted by liquidity. So we have a high, quote unquote, suggested by liquidity on the 15th of August. We had a high on the 11th of August. And there's a rule here that this is the first time I get to see it in real time. But when you see a forecast date, a key forecast date like this one, August 11, and I can show you other examples of this. So you don't have to take my word for anything I'm saying here, but I have noticed that, okay, this is a turning point and it produces a high, and it did. Bitcoin went to 120 and it retreated. That tells you that, okay, that's a potential high. All right. What negates that in my studies is once a day, the 3-day trading rule. So we need 3 consecutive closes above the high on the 11th of August in order to say, okay, that forecast that we had for a high, dismissed, because Bitcoin has rallied and stayed above for 3 consecutive days above that high. So it's noise, or it's quite interesting that it's making this high, but it's not an important turning point. Remember, some of these just produce a 1 or 2 day reaction, sometimes a single day reaction. What am I trying to say here? What I'm trying to say is Bitcoin never went for 3 closes above the August 11, 2025 top. And again, sometimes it sounds like I'm just making excuses for not getting the actual high, but no, guys, I've actually seen this many, many times. On top of that, so we have the 11 on the forecasting model. We have the 11th, put it right there. And then we have another forecast for a high, which I totally did not think would matter. But if you look at this rally here between August 4, I think begins on global liquidity. And Alex, my friend, please pay attention to this, because when you ask me what I think is happening, this is what I think is happening, okay? I'm going into it right now. Notice that global liquidity peaks on the 23rd of September, all right? But between these two dates, August 4 and September 23, there's of course this liquidity line goes up and down, but the biggest like down move within that up move, well, we just went through it. It's this one right here from 15th through the 23rd. That's it. That's the biggest. And I honestly, no, I did not think that Bitcoin was going to, that this would like line up with a move in Bitcoin. Not at all. Like I don't understand this relationship yet. It's almost magic, except it works. So if it works, it works. Again, I don't accept the conventional explanation of, oh no, it's just reacting to liquidity. I don't think that's what it is. I can show you some examples of why I don't think that is, because this correlation exists even during times when there's no way for gold to forward price a crash. Like COVID, for example, is a perfect example. So this correlation is weird, and I will say it will not last forever. Why am I saying that? Because this is what I call the modern correlation between central bank liquidity and Bitcoin. It was not like that if you go to 20, and we're gonna go through it here probably, because you may want to know. It was not always this way. So you would see this correlation between liquidity and Bitcoin. There's definitely something to it. And yes, it makes total sense. That liquidity would lead Bitcoin. Bankers debase the currency, hard money assets like Bitcoin go up. That makes perfect sense. I think that correlation will generally always be there. In general. So there will be exceptions, there have been exceptions, but in general, I think that correlation will be, well, it will continue to work for the foreseeable future. But this super tight correlation where every twist and turn in liquidity forecasts a move in Bitcoin, yeah, I don't think that's going to last forever. All right, but that being said, notice that liquidity was pointing to a weak rally between August 4 and September 23, and Bitcoin. And then we have our own forecasting model, my own forecasting model, saying, hey, there's a high potentially here on the 11th. So Bitcoin breaks above that high, it goes to a new all-time closing high. So then I trigger, or the countdown, the 3-day rule countdown triggers. And I know I didn't say this in the Discord. Sorry, maybe I should have. I was very skeptical of this breakup, very skeptical. Not because liquidity was doing this mini dip. It was simply because liquidity itself is telling us to expect that we rally, but here's Bitcoin making the all-time highs. So unless Bitcoin decouples from liquidity and begins to rally strongly, which is always a possibility, but unless it does that, then that move, that breakout, I'm not buying it. Not buying the breakout. I just don't believe in it. I don't believe we're going for new highs. And so I triggered this. So I was counting 3 days. So okay, we have one close on the 13th of August above the high on the 11th. And then on Thursday, and I remember this because I pulled out my phone. This is when I was getting to Mallorca, and I pulled out my phone. I looked at it and I said, there it is. There's a sell-off. It's lining up with liquidity. So what's happening? Bitcoin here is just was trying to rally against a backdrop of weak liquidity growth. So big rally, weak liquidity growth. And as of this correction here, now they're back in line. So now they're back in line. In other words, the move that took place brings liquidity back in line with, or rather Bitcoin back in line with liquidity. And now I'm liking the price action as far as what I think is going to happen, which is a whole lot of nothing. I do not think that a big rally is starting now. I hope so. I'm hedged here, but I'm still invested. And I have the weakest hedge possible. I have put spreads, which means I bought the 110 puts and I sold the 100K puts to make that cheaper. And I'm being tactical about it. I tend to buy during rallies. I just bought more just now before I jumped on this. So I am skeptical of the rally, but I'm still going to allow myself to make some money if I'm completely wrong and Bitcoin just explodes higher, which I hope it does. But I don't think it will. I just don't think it will because why? Liquidity showing weak growth between now and September 23. Now, On the forecasts, we have, and I'll get to your questions, Perry, in just a minute, but the forecasts have a turning point, which is a low, let's be honest, it highlights a low sometime between September 13th and September 20th. So that's the forecast. Now that's a low. However, if we overlay this, and I did say this on the channel, if we overlay liquidity on top of the forecast, we get that September is more likely to be a high than a low, or at least one of the dates is more likely to be a high than a low. Because remember, we have two dates, September 13th and September 20th. Maybe Bitcoin begins to rally, it falls into the 13th. I mean, again, I don't think we can use liquidity that way, but there's a bit of a dip there with liquidity. So maybe it begins to rally, then it begins to fall, then it makes a low on the 13th, and then it rallies into a high on the 20th. Now, the reason I think the high is going to be closer to the 20th than the 23rd is because I looked back, and usually it's the forecasting model that pinpoints the actual turning point rather than global liquidity. Global liquidity and Bitcoin can be a little more off, or tend to be off a few days more often than my forecasting model. However, I mean, which is, I'm splitting hairs, I think is a term. Like, it doesn't matter. It's got to be the 23rd or the 20th. It doesn't have to be on either of those dates. I could be on the 18th. I could be on the 26th, and I would still consider it a success, a remarkable forecast. It was made back in August, and now here we are. Now, what's going to happen then? And this is why I don't know that the rally has legs. I don't know why Bitcoin is rallying, but we all know Jay Powell's giving a speech, Jackson Hole. I'm guessing he's going to sound dovish, and the market wants to think that he's going to cut rates. That's what the market wants to believe. I'm not sure he's saying that, but that's what the market wants to think, and so it's primed. It was primed for a rally anyways. Why is it primed for a rally? Well, the reason it was primed for a sell-off last week. Why is it primed for it? Because of liquidity. So liquidity shows modest growth. Bitcoin tried to go for a strong breakout. That's not modest. That's a strong breakout. So it failed. But then it tried to go for a strong sell-off. But that also contradicts liquidity. So now it's rallying. So you see, it's just falling in line with liquidity. It's just following liquidity, literally following liquidity. I am every bit as confident that it's not going to crash as I am confident that it's not going to break out. It's just, it will stay put. And we all know the next time it goes to 120, people are going to sell. Like, they are going to sell. I might be among those people. And I might break the rule because I don't want to give trade recommendations. I just want to move away from trade recommendations. I want to give you guys tools, information. I want to share with you what I'm doing. I think that's far more honest than saying, oh, do this, do that. Alex, you know very well, my friend, that's super hard constraining. You can't trade the way I trade, so you can't follow what I do. You don't trade options probably, or not the way I trade options. You're not hedged. You don't have income strategies that can cushion. Like, I can pay for these puts by just doing yield farming, by levering up my Bitcoin position. Can you do that? No. Then if you can't do that, then maybe you can't afford to hedge because they're too expensive right now. Those hedges are pretty pricey. So you can't trade the way I trade, but you can kind of follow my train of thought and make the strategies that I teach your own. I want to do more of that. So I might actually share with you when we're reaching the end of September and Jay Powell has to make his rate cut announcement, which I think will just disappoint the market. It will disappoint the market, and that sets us up for the next 80-day cycle sell-off in October. By the way, my friend Alex, I think you'll appreciate me saying that's part of the reason I'm opening a hedge fund with this guy. Alex is my partner in the hedge fund. I'm opening that because that's the only way to deliver. It's either education and you learn to do it yourself, or we handle the money. There's just no other way. It's just alerts and whatever. It's not that they don't work, they do. But you can't just follow what I do unless I'm doing it. Anyways, that's enough of that. So, big rally on hopes of a Fed cut. Liquidity is telling us an 80-day cycle high somewhere around the time that that the Fed has to make a rate hike, a rate decision. I wonder what happens. I mean, listen, we have not seen divergence between liquidity and Bitcoin so far in this bull market outside of two very specific events. Number one, ETF approval date. They diverged. Liquidity went down, Bitcoin went up. That's one. Two, failed Trump assassination attempt. So those 2 weeks between the failed assassination attempt and the speech that took place late July, that's the only time we saw liquidity go down and Bitcoin go up. So unless we have a strong catalyst in the second half of December for Bitcoin to buck the trend of liquidity and continue to rally, I will say that's it. It's gonna stay contained here, Bitcoin that is. And then when the Fed has to make their decision, Jay Powell disappoints once again. And I honestly don't think he should be cutting. Like inflation is going up, the U.S. government is running too high deficits anyway. He shouldn't be cutting. There's a lot of reasons not to cut, and financial conditions are pretty loose right now, as evidenced by the stock market being at all-time highs. I know it's more of a political statement, and you can point to pockets of the economy that are weak and could require a cut. I think credit card debt, whatever, that type of stuff. Like the consumer is hurting in the States. I get that, but if you look at it broadly, should he be cutting right now? I don't think so. The dollar is super weak too. Like it went way down. So I don't know that he should be cutting. So that's where I see things. Where I see things is okay, we're just following liquidity here. We're not getting the breakout because liquidity is not breaking out. So if you see Bitcoin break out to the upside, fade it. If you see it breaking down to the downside, fade it. It's just gonna stay contained in range. Why am I hedged? You might ask, if I don't think that that Bitcoin's going to break down. Well, because I have to. I run an automated strategy. And the automated strategy has me hedged whenever Bitcoin breaks below the 80-day cycle VTL. I think we discussed it in the last AMA. So if we're trading below the AMA, I'm hedging, period. I don't care what my opinion is. Now, this is personally how I do things, is if I know I have to hedge, like I have to hedge because Bitcoin is below the VTL, but I don't think there's a lot of downside, what I do is I buy cheap hedges and I trade around them a lot. And if I see that Bitcoin is really not going to crash, I start selling back those hedges. I just start unloading them. That's how I do it. Because there was a trader that I used to follow years ago. One of his favorite sayings was discipline before conviction. He would always say that, discipline before conviction. So based on my research and the way I like to trade, whenever Bitcoin trades below the 80-day cycle VTL, I talked about it last in August. Sorry, we're in August now, in July. So last AMA, I talked about the same thing. And if Bitcoin breaks the VTL, listen, it's like a weather forecast, right? Like it's not going to be sunny outside. It's not going to break out. It's not going to do well. And there's a chance for rain. There's a chance we get a crash. It could happen. And so the best thing is to be hedged, but a weak hedge. You don't wanna be selling. You don't want to be having just naked long puts. Put spreads is where I land as being the best possible strategy. Now I did have some 119 puts in August expiration, which is next week. I did sell that Bitcoin because the puts were in the money. So I just sold and I bought a $120, 120K call, September expiration. So in that case, if the hedge goes in the money, I'll sell. But I buy a call as a hedge against being wrong on that front. So I hope I'm making sense. So anyways, that is the outlook. Probably going to see more strength as we head into Fed week. And then once we hit Fed week, it goes down from there. Which leads us to the next key point, is what happens next. Well, let's see what happens next. So liquidity is doing okay here. We have a low in October, which I highlighted also here. Let me delete some of these. We have this low in October. I think it's the 23rd also. Yeah, it's the 23rd. And we do have a strong low forecast for the 17th. So, to be fair, okay, between the 17th of October and the 23rd, that's when the next 80-day cycle low might be. Now, the key here, and one of the biggest takeaways for me today that I want you to take home with you is, what is this? Oh, never mind. So one of the key takeaways here is, okay, what's going to happen next with liquidity? Because right now it's doing okay. When I started tracking this indicator, we were like, I think we were here. So we could see, quote, see all the way through to October 30th. October 30th, 2025. From there, liquidity was just, again, just rallying from the October low, but not doing much. Then it started to dip. And I was like, okay, no, that's not good. We shouldn't see that. Liquidity needs to go up because that's what tells us that the bull market continues. If liquidity falls here and it makes new lows, then we're looking at September 20th being the bull market top potentially, or at least the high of the year. Why? Because there's not enough time. There's not enough time for Bitcoin to recover by the end of the year. So hope we don't see that. If we see a rally and we see liquidity break above the September top, then probably not going to sell at that point. I might still do it. So what I would do is around September 20th, I would sell all my Bitcoin and buy 120 calls through October expiration. And if you see Bitcoin dip, you sell those calls and you try to nail this low. That's how I'm trying to play this. I'm not sure I'm going to do it with all my whole stash. I don't know. I haven't made my decision yet, but that's what I'm watching. And I think the key here, there's two keys. One is liquidity going to break to new highs? And the other one, and I'll wrap after this and I'll get to your questions, but the other one is gold. Gold is trapped in a range. You can see doing pretty well here, and let's get rid of liquidity. So as I said, gold is a leading indicator for Bitcoin, but 6 months. Suffice to say, so far gold has a key top here in April. 6 months from there is November, so that points to a November high. But the thing is, gold hasn't crashed. So since making the high in April, gold has flatlined. It's done nothing. And so if gold breaks out to new highs, what is this telling us? It's telling us that the bull market goes into 2026. Because gold so far has stopped for like, well, let's see here. So all the way, it's still stopped here in September. Sorry, no, let's call it September already. And if we add 3 months, I mean, that takes us to what, March? So it would point to maybe a consolidation period between November and March, and then Bitcoin would make new highs after that. Again, this gold correlation isn't as strong as global liquidity itself, but it's still pretty strong. And so if gold breaks out to the upside, that tells us that the bull market might continue into 2026. And if we go back to Bitcoin and liquidity, which is a much stronger correlation, if we see liquidity break out to the upside, well, that's bullish too. So I want to see both. I want to see liquidity break to new highs, and I want to see gold break to new highs. If we see those two, then at this point in the year, we can say that the bull market continues into 2026, which it would be great. It would be great to see. And has that happened before? No, that would be the longest bull market probably in crypto history. But then again, this has also been the weakest market in crypto history. And don't even get me started on the altcoins. Most of them are dead. And so, well, Ethereum woke up, and I hope we can cover that also here, but this is an AMA, so I'm just going to get to your questions now. All right, so let me get some water too. So the time alignments, Perry says, the time alignments are of gold to liquidity to Bitcoin are another quote unquote proof of Bitcoin being quote digital gold. Yes, Perry, I agree. The fact that there's a correlation at all between these and these shift constantly. And I'm going to show you that if you want. I'm going to show you the correlation between Bitcoin and gold because that one is just fascinating. Now you have to do a weekly chart because gold it doesn't trade on the weekends or on holidays, so you can't do like a one-to-one comparison. So on a daily basis, so I do weekly, and the correlation is just incredible. Like 6 months forward for gold translates to highs and lows in Bitcoin at big highs and lows. So the 320-day cycle, not the smaller moves like you see with liquidity. The reason I'm just fascinated with liquidity, right? And I just want to be clear. I don't know that this will last forever. I hope it does. It's like having a crystal ball. I just don't think it will. That being said, Bitcoin follows liquidity very closely, especially central bank liquidity. We get all the 80-day highs and lows, the 320-day cycle highs and lows, and we even get these smaller moves. Like we're getting everything just by looking at central bank liquidity. If you look at gold, it's only the big moves that show up in the in Bitcoin. So they line up at important highs and lows, the 4-year cycle highs and lows for sure, always. 320-day, most of them. So you see a lot of correlation between them. So yeah, to answer your question, if that was a question, oh yeah, there's a question mark. So yeah, I do think that the market treats Bitcoin as a safe haven, which is why it trades with this interesting correlation with gold. However, gold is a forward-looking indicator to Bitcoin, which is awesome because trading gold is great, but it's not as rewarding as trading Bitcoin. But if you can use gold to trade Bitcoin, I mean, that's just gold. Pardon the pun. Anyway, so so Perry's saying maybe some big banksters. Did I read that right? Oh yeah. Maybe some big banksters in the early liquidity printing pipeline are literally buying large amounts of BTC on exchange as they get their hands on new liquidity, controlling price. Remember, Perry, so Bitcoin moves 84 days after liquidity moves. 84 days, that's 3 months, almost 3 months. That is strange. But look at the correlation, it's undeniable. The correlation is undeniable. Now you have to do some curve fitting here, but not in a bad way, just so you can see that both charts are doing the same. You just kind of have to bring them in line like this. You bring them in line, there we go. And then you see how it's just one moves with the other. So you might say, well, they're moving together until you remember that one of them is forecasting the future 84 days for you. And then it becomes a fascinating indicator. And I just want to show you one thing here because it doesn't always work. Of course, nothing is perfect. This is one time when it didn't work. And notice this divergence here. So they're following each other and then they break. Bitcoin up, liquidity down. And then we have this low in August, which in liquidity, again, it was a bit off. It was July 23. This is partly why I said, this is the reason I said that if you have a low, say on July 23, you have to look at the forecasts to see if you have a low that's close to it. And in this case, what we had is August 6, this low here, right? So you can use liquidity to say, okay, we're coming into an important low. Let me look at the forecasting model to see where that low is going to be exactly, because it doesn't always, it can be off by weeks in liquidity. So in liquidity, we can be off by weeks. With the forecasting model, we can be off by up to 4 days. So not weeks, just a few days. So it fine tunes the forecast. In other words, if I'm looking at this chart, I don't know what's happening here in July. I'm expecting Bitcoin to fall between the high on the 31st of May, which funny enough, in this case, this is funny because the forecasting model, I don't have the forecast here because I scrapped them once the year goes by, but I think we also had a high exactly on May 29, which is between, this reason I say that's interesting is because it was between these two highs, a double top. So between that double top, there was a forecast for a top. And sure enough, liquidity tops out exactly then too, on the 31st of May. So between the 31st of May and let's call it early July, early August, late July, nothing but downside. That's what liquidity is showing us. But Bitcoin rallied. It rallied starting on, so it took a break here, but then it started to rally on the 13th, I believe it was. This is the failed Trump assassination attempt. That gets Bitcoin to decouple from liquidity, but only briefly, only for a little bit, because they both fall into this late July, early August low. So Bitcoin decoupled from liquidity for just a couple of weeks, showing you that the reason I love this is because if you look at M2, that kind of obfuscate the actual relationship between liquidity and Bitcoin. But if you look at central bank liquidity, you can see that at times there might be catalysts or things that make Bitcoin break with liquidity. We saw it here with Trump. That's not the big one, though. The big one was the ETF. ETF is here, and this is like, actually, I wrote a post on this on my Substack that I think you can, it's free, so you can see it for yourself. I don't know how to line these two charts up. It's hard to do. But notice that liquidity was basically after pointing to a low here, an important low sometime here in September, late September, liquidity is just making, let's see if we can do this, because I mean, we have to cross them. But so we have this rally here. I'm not doing a good job with this. Let me see. There we we go, like that. Okay, there we go. I think that showcases what I mean. And honestly, this is the first time Bitcoin breaks with liquidity because they were just lined up prior to this. Come on, load. There we go. So you see how they're lined up? All this is 2023. This is Jan 1st, 2023, right there. You see how they're lined up? They're totally lined up. So they're both doing the exact same thing. You can say that all of 2023 is just liquidity, just following liquidity, goes up, goes down, follows liquidity, follows liquidity. Oh, that's not a good one. There we go. It keeps following liquidity. And then we get to, I suppose it was here actually, September 12th. There we go. And then we go into early September, and then Bitcoin begins to climb. And liquidity keeps falling. Now, you know what happened here. What happened here is ETF rumors begin circulating. I think what started it, I had the AI look into this. I think what started it back then is that the SEC lost a lawsuit against Grayscale, the issuer of the GBTC closed-end fund, which they wanted to convert into an ETF. The SEC said no. The Grayscale sued the SEC. They lost the lawsuit. I think, I could be wrong about this, but I think they lost this lawsuit in September, which started speculation. Oh, maybe the SEC is going to move to approve the ETFs. And then in October, the SEC says that they're not going to appeal the decision. So they're not going to contest the courts. They're just going to, I believe that what the court's order is a reconsideration of the filing to become a true ETF. And around the same time, I remember that BlackRock was filing an application, or that was earlier. I think that may have been in June or in July of 23. So suffice to say, all this ETF speculation came to a head, especially in October of 23, and they just decoupled. So Bitcoin began to surge. This is to this date, since the bear market low, November 22. This is the best rally Bitcoin has done, or in crypto has embarked on. Is this ETF fueled rally? It's clearly an ETF fueled rally. It clearly is not liquidity, because liquidity is falling in that time period. But guess what? It gets even better than that, because when you fast forward to what happened in January, look what happens in January. This is amazing. Like, this almost seems like a joke. But you get to January, ETF approval. So the ETF was approved formally on January 10. You get to January 10, what's happening now is Bitcoin liquidity, they just fell back in line again. So as soon as ETF got approved and started trading, liquidity and Bitcoin fell right back in line, resuming their normal correlation. I mean, that's incredible. I mean, that's crazy that this would happen. So just fascinating. So like I said, they don't always move together, but generally they do. This gives us another lesson here, which is if you're going to make the case that Bitcoin is going to decouple from liquidity, there's got to be a reason, and there's got to be a strong reason, like ETF or pro-crypto president being almost assassinated. Like, there's got to be a strong catalyst for that decoupling. Do we have that now at present? Do we have that with the Fed? No, I don't think we do, but maybe we will get such a catalyst. Maybe I'm wrong. You guys can look to see if this is not about Jackson Hole speech. If it's not, then hey, that's good. Maybe there's a catalyst. Maybe there's a case to be made for new highs in the price of Bitcoin. Maybe. I just think this is just Jackson Hole and disappointment following Fed refusing to cut, or they can cut, but they don't cut enough. Like, that could happen. It's like the ETF. Why did Bitcoin fail after the ETF was approved? Oh, not enough inflows. Not enough inflows. Like, okay, so if the market sets their hope on something, then that something always leads to disappointment. That's why buy the rumor, sell the news is so powerful. It's because people buy in anticipation of something, and then when there's something happens, it's never good enough because all these expectations have been built into the price. All right, so moving on. So Alex is saying, in your opinion, does crypto follow in line with Bitcoin over the next month, or is there a chance for crypto to finally break out against BTC? That leads us right into ETH, my friend. So let's go into ETH. So ETH follows liquidity even more closely than Bitcoin. Let's just start with that. That's awesome. This is my favorite chart. I actually wrote about this at the on the Wise free the free thing they publish every Friday. You're gonna see this article, and it's my favorite chart in crypto because it's just, I mean, now we're looking at the same thing, whereas this is since, oh wait, where are we? Okay, this is since January of 2024. We're looking at the same chart. This is the same chart. Central bank liquidity overlaid on ETH, 84-day offset. You get the same thing, the same chart. All these lines, which I'll delete. We don't need these lines. All of those lines you just saw, those are all the 320-day cycle lows aligned between between Ethereum and liquidity. And yes, the 80-day cycle lows line up too. It's just too many lines on the same chart, but it's incredible. Now, sometimes you get this big rally on ETH, rally on liquidity. This is when the ETH ETF got approved. So why did ETH rally far more than liquidity? ETH ETF getting approved. So it just lifted the price a little more than liquidity suggested, but not by much. And then they line up at the highs and lows. All the important highs and lows are here. You can see all of them. So ETH, suffice to say, much more strongly correlated to liquidity. Again, in this bull market, we can go back before if you want, because if you do, you're going to notice they haven't always been this correlated. But so far in this bull market, they are. And I think right up until we hit the end of this bull market, I think they're going to remain in strong correlation with one another. Now, personally, I don't always subscribe to these theories, but I personally think that people are actually following liquidity this time. So this is, I do think that this one is a case of a self-fulfilling prophecy. Enough people follow Raoul Pal on X and Michael Howe and all these liquidity analysts, and they all do the 84-day thing. And so everybody's looking at these charts, and I do think it's leaning to a bit of a self-fulfilling prophecy. And the reason I'm saying that is because, yes, it's true. Liquidity and Bitcoin have always been correlated, but not this correlated. It was a loose correlation before. Now it's like 1-to-1 almost. It is like, yeah, it's a high percentage, like 90% correlated. It's ridiculous. So I think it's a bit of the tail wagging the dog, I think is the term. It's a bit of a self-fulfilling thing. But ETH, the reason, to answer your question, Alex, you go to the present, and ETH is a proxy for altcoins, in my opinion. So look what's happened since the Genius Act was passed. Roughly, not exactly, but roughly. Because yeah, I looked at the dates with ChatGPT or Perplexity. Shout out to Perplexity, I love it for search. So I had to compile the dates when the Genius Act was passed, and it wasn't July 14, which is where I drew this line, but it was around this time. First, it goes to the House, then there's a discussion, then it goes to the Senate, then back to the House, then the president signed it. So this is what happened in July. So what happens in July is liquidity saying peak on July 14, my birthday, by the way, and Bitcoin peaked, if you remember, Bitcoin peaked, but not ETH. ETH kept going. Not only did it keep going, I mean, it's decoupled from liquidity. It's just completely decoupled. Liquidity showing us a flat line, and ETH is straight up. So do I think Bitcoin follows? So I think crypto follows BTC? No, we're seeing a bit of decoupling. Now, how long? I just showed you these decoupling moments, they don't last forever. So they lead to something, and then the correlation goes back in line. So guys, they'll fall back in line. Eventually, the liquidity is going to be correlated 1-to-1 with ETH again. And I just showed you it's much more strong, this correlation between ETH and liquidity. Expect that. That will happen again. Put a gun to my head. When is that going to happen? It happens when Jay Powell refuses to cut, or disappoints, it doesn't cut enough, or he does cut and he doesn't disappoint, but people still sell. Like, I don't know what Jay Powell's going to do. I'm just pointing out that was my forecasting model, and this liquidity indicator both point to a high that just happens to be around the time the Fed has to make a rate decision. I mean, coincidence? I don't think so. And yes, I've seen this before with gold, and I've commented on that before. Also, I've seen this before. I've had forecasts for Fed Day, and that happens to be an 80-day cycle high or a 20-week, because I was looking at gold, so 20-week high or low. So these things happen. And so I think ETH has a very decent chance to run. And if it keeps running, I think it pulls up the alts with it too. I think there's a chance for this. So I'm a bit lukewarm on Bitcoin. I'm not sure what's going to do much between now and September, but I think ETH has a very decent chance of actually staging an important rally. Now, one thing I saw though is about 900 million ETH have left staking, so they're being unstaked, and they are presumably going to be sold. That is a wall of liquidity hitting the market probably when it hits 5K, and it's within the next 10 days. So there's another catalyst for potentially ending this strong so far ETH rally, and that is the unlock of this massive amount of ETH, about 900K. I think it was like 888,000 ETH being unlocked. I believe it's in early September. That's when the unlock takes place. We've seen that before. Like I usually dismiss these. I don't comment on these, but when this whale moved 80K Bitcoin to exchanges, people started selling. So, okay, so maybe they do the same thing with ETH. So ETH remains strong for now, but am I convinced that this thing is going to go to like 9K like people are calling for? No, I'm not convinced. I need to see what happens when it goes to 5K. Why? Because I mean, we've been here so many times before. Altcoin hits, altcoin doesn't do anything. Altcoin gets to the all-time high from the last bull market. Altcoin crashes. I'm talking about Solana. Look at Solana. Altcoin doing well. This dashed line is the old all-time high. Let me just hide this. All right, there we go. So all-time high. Just here's proof. Goes to the all-time high, boom, people start selling. And I think it was Brett that warned me about this. I think he texted me or he warned me about this. I don't know. You guys tell me. I think Brett was actually talking about this. I don't know what he calls these, like the wall of selling or liquidity wall or something. But I mean, come on, it went to the all-time high and it crashed. So, and it crashed, like literally crashed, unable to recover. Maybe it does recover now. It's doing okay. It actually went up to 200. Shocker. So the high is 250, 270. What is this? I think it hit 300. Yeah. So on an intraday base, so we're hitting the all-time high, we're hitting 300, boom, crash. And this is a bit of a crash. I mean, it sold off by 66%. That's a big sell-off, which you can get in a crypto bull market for an altcoin after it has done a 50x. This thing did not do 50x. I think it was 15x. So not that great. 20x, something like that. So ETH still has some work to do here, because when it gets to the all-time high, let me highlight that because I need to see it on the chart. I mean, this is one of those lines you have to have. I mean, crypto it can be predictable at times. Sometimes it's wild and impossible to tell what's going to happen, and sometimes it's just like, well, you can see ETH approaching 5,000 and $4 billion, $5 billion worth of ETH unlocks. And I also saw that there's like so that's a record number of unlocks on stakes, on staking requests. I don't know what they're called. And there's also a record low number of people trying to stake. So this ETH is staying liquid because people want to sell it. That's the only reason. If you're not staking your ETH and a lot of people are unstaking their ETH, it's because they intend to sell. So there's a wall of selling coming for Ethereum, a wall of selling, which is why I've had this back and forth with Weiss, with the company I work for, where they're like, "What do you think alt season? Do you not think alt season?" I'm like, guys, the problem is like it's only ETH so far, and there's a wall of selling about to hit the market. And sure, if we get past that, yeah, maybe alt season. If we get past that, let's see what happens as we get to Fed meeting. Let's see what happens as ETH goes here to the all-time high, which you could argue kind of got there, but not yet. So let's see what happens. I'm very optimistic. Full disclosure, ETH is my second largest position behind Bitcoin only. That's mainly because I mainly trade Bitcoin. So, and that's like it's not a non-trading allocation, but I just hedge it. I rarely get out of it. Whereas altcoins, I just trade back and forth. So I have significant exposure to ETH. I'm only saying that because I'm not bearish. I'm just looking at it. And just like with Bitcoin, if I don't see 5K ETH, before September 20th, I'm selling it too. Whatever the price is, I'm selling it, I'm getting out of it. Because okay, we're running out of catalyst, Fed is behind us, and yeah. So I know it's a very long way to answering that, Alex, but I think there's a very, very good chance that we're gonna see strong performance from the altcoins for the next month at least. But I have some concerns. Now, for now, there's just concerns, and I think the right way to be positioned here is to be long, but to also not lose sight of the fact that we have seen this picture with Bitcoin before, where it decouples from liquidity. They fall back in line. It doesn't last forever. I don't think Genius Act is as strong of a catalyst as ETF being passed. Don't think that's gonna lead to, because remember, when the ETF was passed, it was October, November, December. That's basically 3 months of decoupling between liquidity and Bitcoin. And this Genius Act thing would be a 2 month affair if ETH decoupled here in mid-July and it runs into late September. So that's it's like a 2 month decoupling. And so I would expect them to both fall back in line right after that. And so we go back to the key question: what's liquidity going to do? Well, again, I like this. I like this rally, which took place today, actually. So maybe, so remember, this is forward looking, right? So this liquidity thing is, so liquidity went up today, right? This move here, the latest candle or the latest read, that's today. Today, liquidity moved higher. So maybe Jay is making moves. Who knows? But I think he'll disappoint. I don't think he's going to do what Trump wants. And the reason I don't think he's going to do what Trump wants is because Trump wants him to cut too much. Number one, he wants him to cut like 300 basis points. That's insane. That's irresponsible. Especially when there's nothing breaking quite yet, so you can't just cut that aggressively. And the other thing is, he's gonna get fired. He's out anyways. And what does Jay care about? Well, Jay cares about his legacy. He cares about how he'll be remembered. If Jay stands firm, defies the president, which scores you some points in Washington, I hear, because not everybody likes the president. So it'll score him some points if he just defies Trump. But beyond that, he gets to leave his job getting to say, you know what? I fought inflation the moment I saw it. I held rates steady and high. I said higher for longer, and you got higher for longer. So I did what I said I was going to do. I walked the talk. So there's a lot of politics into whether or not the Fed should cut. And I think most of the politics points to Jay disappointing. He's not going to do what the president wants. He is independent. And the next Fed chair may not be as independent. That's good on them. You're seeing this record number of dissent at the Fed, at the FOMC, of course, because these guys want the job. Like some people are going to line up with the president because that probably means they are on the short list for being picked as the next Fed chair. So that I'm just being a little cynical here, but of course people are dissenting. The president is saying cut rates, and it's Jay who holds the job who's saying no, I'm not cutting. So yeah, I can't wait to dive into what exactly he said, but that's what's happening here. I don't count on the Fed being your friend because liquidity is telling you not going to happen, and you also have all these politics. All right, let's move on. So Perry's saying, I am surprised you don't buy your put spreads just below the 110, 100K, such as 107, 97K, since the price can dip a little below the psychological round numbers and thus not get your puts assigned. So I just like to go with round numbers, I guess. I mean, there's no reason to do 110 versus 107. It really comes down to price. So for example, if I buy more puts today, with Bitcoin rallying all the way to, because I mean, when you're buying puts, they offer the most protection the closer they are to the money, right? Closer you are to the money, the more protection you're going to get from those puts. So you want to close, you want to buy as close, if I could, I would buy 117 today or 116. Very close, but those are expensive. So I have a rule for this, a bit of a rule. And I typically don't want to spend more than 2% of a Bitcoin on a hedge. So when I come in and I start hedging, I looked at the price of the 110s. They're the same price today. It's about 2% of a Bitcoin. So today I'm not buying put spreads because I'm spending 2% for the outright put. Whereas when I started hedging here on the 19th of August, I was in the put spreads because I could buy the 110 for 2%. Now I was supposed to be hedging every day that the prices remain below the VTL. That's what I told myself. But yesterday I didn't do that. I didn't buy any hedge yesterday because I was like, I can do what you said, Perry. I can buy 107, which is my price range, or I can just wait for prices to rally because I'm pretty sure they're going to rally anyways. And they're rallying now. So, I mean, it's like there's no right answer with options. You just got to go with whatever you think makes sense. Now, why 110? Because I think 110 is where support really is. And if Bitcoin were to break 110, which I don't think it will, but if it did, I would think that that makes for a quick move down to 100K, which is the next level of support. And I just want to capture that. So that's why I did 110, 100. Again, there's no right or wrong answer here. Personally, I do think that whenever prices are crossing the VTL, you have to be hedged. And if you're super bullish still, then you can just hedge with you can just put a very weak hedge on, which is what I'm doing now. It's a weak hedge. I'm probably going to roll up the puts at some point. I also bought a bunch of calls just in case it breaks out. I have what I think it's called a strangle. It's an iron condor, but I didn't sell it. I bought it. So basically I'm also long the 120 calls. I'm long the 120, the 110 puts. I'm long the 120 calls. Right now, that's, again, doesn't make it right, just makes it honest. That's what I have. Now the 120 calls is just, I think, a couple. It's just I'm trying to speculate on the price of Bitcoin, nothing else. Whereas the puts are definitely a hedge. This is not a move that I think happens. Now the reason I have calls too is because one thing I didn't point out, if I zoom out, notice that liquidity has been making lower highs and lower lows. Zoom out even more. So liquidity is making lower highs and lower lows. I'll zoom in this. Goes up, goes down, goes up, and it goes down. You get the picture. It's lower highs and lower lows. Whereas Bitcoin is making higher highs and higher lows. All right, so hold that thought. Bitcoin's making higher highs and higher lows, whereas liquidity makes lower highs and lower lows. Which means every time liquidity makes a double top, right, or a lower high, there is a chance for Bitcoin to actually make a higher high. It's already done that. Now, this is an incomplete thought because, yes, it's true, liquidity making lower highs and lower lows, Bitcoin making higher highs and higher lows, but on a bigger cycle. So liquidity is doing that on a cycle that's about 320 days, actually. There might be a 320-day cycle to liquidity. So you see, so it's doing it with these big moves that you see here. It's not doing it with these moves. In this case, it seems like it's a one-to-one correlation. In other words, if liquidity breaks out, Bitcoin breaks out. Liquidity doesn't break out, Bitcoin doesn't break out. So, it's like, we don't know. And the other thing is, it did break out. Like it did make a higher high here. You got to respect that. Even though Bitcoin hasn't actually been behaving very well, it hasn't trended well since May. So since May 18, which is when it broke out to new highs. It's been engaging in this pattern of distribution, which liquidity tells us will continue. But there's a chance. So ahead of this breakout here, I went in and bought some calls. Again, doesn't make it right, that just makes it honest. In May, I also bought the 150K calls. That's out in December. Apparently, I was not the only one doing this. A lot of people were doing that. So the 150K calls, December expiration, and shorting the 200K calls. I have that too. I've had it forever. I don't think it's going to work out very well. I bought that, and I also sold the 150K calls in September when I was doing this. So those calls are free pretty much right now. I own them for free. It's a free shot on Bitcoin going to 200K. Why not take it? So Perry saying, yeah, your options protection plan sounds like an iron condor. Yeah, that's what it is, which is I think stays profitable when the center price band, although there's also a reverse iron condor, which is the opposite, still get them confused. Yeah, I don't tend to fixate on these names. What I have is something that if Bitcoin breaks out of the range, I'll make money. Now, again, if it breaks to the upside, it purely makes money. Whereas if it goes down, because I hold Bitcoin and I haven't sold, I sold a couple, but not much. Whereas I mostly hold Bitcoin, which means that if it goes down, it's just crash protection, and if it goes up, I actually profit from the move. All right, so late May doesn't seem like liquidity lined up with BTC though. Made massive jump in liquidity, but not in BTC. So it depends on how you line them up, right? They are lined up, in my opinion, because you start the move here, late March, early April. They rally into a high on the 8th of June. They both fall into a late June low, and then they resume the rally. So yeah, they're correlated. Again, they don't have to follow each other like one to one, but they're roughly correlated. The biggest correction in global liquidity at the time, again, forward looking 84 days, it was between June 8 and June 24. And the biggest sell off that Bitcoin experienced since making lows around the same time is May 22 to June 23. So it's pretty good. I mean, this is just a reference. I mean, if you add the forecasting model, the cycles on top of this liquidity thing, I think you have the best tools for trading Bitcoin that I have ever seen. So it's pretty powerful. Like, I mean, if I didn't have liquidity now, I'd be getting excited. Look at this rally. But I have the liquidity indicator, so I go, yeah, okay, let's see how high it goes. Let's see how high it goes. Because, I mean, we also had a breakout and it faded. Now we had an attempted breakdown and it faded. And just color me completely unsurprised if after this impressive rally, Bitcoin just does nothing. It just slowly climbs higher back into 120. I would not be surprised to see that. Alex is saying, please touch on the altcoin BTC relationship and outlook. I think I answered that already. If not, just ask me again. Perry is saying, is the only reason you have liquidity at 84 days is because it's full 12 calendar weeks. What if it should actually be more like 80 days, which is a Hurst nominal number? Good question, Perry. The reason it's 84 days is, like you said, it's 12 weeks, which is what other people are using. To be perfectly honest with you, I think you can make the case for 80 days, but it doesn't matter. And the reason I say it doesn't matter is nobody's claiming that this correlation is 100% perfect. Now, I will say it does seem like if you use 84 days, the alignment is a little closer. I think it's a little better if you use 84 days. But honestly, it doesn't matter. You should not think, even though it happens sometimes, let me go back to 84 days. So even though it's true that some of these highs match to the day, so if this one matches to the day, this is exactly on the day off. There's a high on the 14th on liquidity. Bitcoin topped out exactly on the 14th. So that's an exact match. This one is a very close match too. The low is on the 3rd or the 2nd. Remember, the way I count it, the low is the start of the cycle, so that will be the 3rd. Whereas liquidity told us to expect a low in the 4th. So that's pretty close, but you shouldn't expect it to be that close. Sometimes it's not that close. This one is a good example. March 26th, and in fact, notice that March 26th is right between these two lows. And so this is when it gets nuanced, right? This is when it gets nuanced because we have this early March low, and we also have an early April low. And the low in liquidity falls right in between. And you may know where I'm going with this. We had a forecast for a low also on the 10th. It wasn't as significant as April, but it was significant. So maybe at the time I would have said, okay, so maybe the low is right here in March. You know, if all I can see is this, there we go. If all I can see is this, right, I can't see what's beyond that, I might say, hey, it looks like March is going to be the low. But lo and behold, we got a double bottom with the liquidity low right in between. It just showed you the same thing happening in May. And the actual low was April 7. Now, April 7 is the highest forecast date for a low in all of 2025. So we should have leaned that way, but you guys know I wasn't leaning that way back then. In March, I would say, no, I think the low is already in. I think it's in March. It's not going to be in April. Well, it was in April. And Perry, this is the third time bringing this up, but you asked me about it. I was kind of dismissing the April 7 low, and it was the low. So keep in mind that when you see this, it looks like a very close alignment, but when you're going through it, you might be thinking, oh, I think it's in March, but actually it's in April. We may expect that in the future. Like we may see that. We may see confusion or confusing signals. Like, oh, we think it's in September, but actually it landed in October, whatever. I mean, that might happen. It's not a perfect alignment. So why am I using 84? Because everybody else is. You know, I think it works if you use 80 or 84. It doesn't really matter. Just somewhere in the ballpark of 80, of 84, I think is fine. I tried 87 days because 87 days is it's a Mercury orbit. Mercury is, to astrologers, it is related to trading. It's a planet of trading and commerce and whatever. And Mercury retrograde periods are very important in crypto. That was taught to me by Ray Merriman. Shout out to Ray, awesome guy. He and I also are going to be working on stuff in the future, so hold on for that. And so I happen to know that 90 days, 87 days is this Mercury orbit, which is this planet that a lot of people look at for turning points in the market. And so I thought, okay, let me try 87. And my conclusion was it makes no difference. 87, 84, 80. So why did I go back to 84? Again, that's what Raoul Pal at Real Vision is doing, or GMI. I believe that's also what Michael Howe at Capital Wars is using. So I'm just going to go with 84 because because we shouldn't expect it to line up exactly. We shouldn't. It's not going to be like that. So the low is not going to be this low in October. It's not going to be exactly on the 23rd. Maybe it is, but it doesn't have to be. I mean, listen, if it made a low on November 3, I would call it a success. Let's say liquidity is rising sharply here and Bitcoin is falling sharply into November 4, and then it makes this low and it breaks out. Would I say the correlation between liquidity and Bitcoin broke? No, I just said, right, it was off by a few days. That just showed you it can be up by weeks, a couple weeks. So I think whatever rocks your boat, Perry, you can use 80 because that's first, or we can use 84 because that's 12 weeks. Which again, I think 4 weeks is a lunar orbit, and I just kind of like it for that. Like it seems to line up with natural cycles. We're close to 87 days. We're close to 84 days, which is 3 orbits, and so I like it. I like 84. I'm gonna go with that. I think it. I like it. I'm satisfied with it. So Perry's saying gold is making an ascending wedge pattern too. Looks like it will break to the upside just on that alone, plus all the other reasons: inflation, long-term pattern, breaks, etc. Yeah, it looks like gold is gonna break out, actually. I actually thought that maybe if Trump can get Zelensky and Putin to agree to a peace deal, then maybe gold breaks down. Actually, I thought that. I was like, oh, it will be interesting if this is very, very good thing for the world and for us here in Europe. Although I'm not gonna be here much longer, but I would like to see peace between Russia and the West. I don't think that these two countries should be at war. They have more in common than not, like culturally speaking. Why are we having this stupid war? So I think if he gets a peace deal, we might see gold break down. I'm leaning a little bearish on gold, I'll be honest. But it's not for a good reason. The only reason I'm leaning bearish on gold is because my forecasting model for 2025 had this April top as very significant. And if all that happens is that gold consolidates sideways for a while, then how significant is that? Then again, just it is the most significant pause since the breakout. Like already, bar none, this is the longest correction gold has been in. So if gold broke out here, I would not say my forecasting model failed. I would say, no, it worked. It worked. It suggested, like you said here soon, gold still drop below 3K. I'm not sure to answer that specific question. So he's saying, just for the record, he's asking, is gold still going to drop below 3K before the breakout? I don't know. I don't know because these sideways corrections do not appear, so they don't show, this pattern doesn't have a strong theoretical foundation in Hurst speak unless it's topping out, right? So sideways patterns should be distribution. So the sine wave is going up, now it's flattening, and then it's going to point down. That is the only time. You should never see up, sideways, up. I shouldn't say never, but that, so the Hurst pure model would tell you that that's a little unusual. You shouldn't expect that, not really. I need to do something with the light here, guys. So good. All right. Okay. Sorry about that. So the Hurst pure model is saying these sideways consolidations, they don't really show up in sine waves. Now, when I've seen it happen is when an asset should be falling, should, with air quotes, it should be falling, but something is keeping it up. So there might be an unusual demand for gold right now because of what you said, Perry. BRICS, inflation, there might be an unusual demand for gold right now. So whereas we should be seeing gold go down, we're not. Now that seems like a cop out. I get it. Here's the thing though. If it breaks above this, look at this. 1, 2, 3, 4. We have a quadruple top. April 22nd, May 6th, June 13th, and July 22nd, breaking at this, let's call it 3,400 to 3,450 level. If you see it break below that, above that, then forget the correction. It's going to go up. And if you want to be a little cautious, you wait for the a new all-time closing high. I would totally buy a new all-time closing high in gold. In fact, like I just said, I wouldn't even wait for that. I would wait for this. Now, the reason I'm not buying it yet is because, like I said, forecasting model is pointing down. It's not just the forecasting model. It's the fact that we have a very overdue, for those of you who watched that lesson, the gold lesson has this important 18-month pattern, 18-month cycle in gold. You find it in the stocks too. So for those of you who only have access to the first 4 lessons, apologize for that. By the way, I have been too busy with too many things. But suffice to say, there is an 18-month cycle on gold as well, and we haven't seen it since October 2023. So it's way overdue. In other words, if we look at forecasts or we look at just pure cycles without any forecasts, gold should be dropping, to answer your question, below 3K. That would complete an actual 18-month cycle. Now, given the unusual circumstances we're in with geopolitical conflict, especially, and BRICS and all of this stuff, I think there's so much demand for gold that we may get a sideways correction on this 18-month wave. It might just go sideways, maybe a little while longer. I'm not sure it's going to break out right away. I don't think it will, but maybe it just goes, just sideways for some time, and then it shoots higher, which would give us continuation of the bull market come 2026 for crypto. And gold BTC is a crazy chart. Let's look at that. Elex. Well, I mean, it's what you would expect, right? This is just, I'm surprised it even goes up. There are times when gold is doing better, probably during bull markets, of course. So I would invert this. I think you can invert that. And so it kind of looks like a Bitcoin dollar chart, kind of looks like a Bitcoin dollar chart, but not as strong because gold is also sound money and it's not being debased. And well, thanks for bringing that up, Marcos, because I think that one of the signs I would expect that a sign of a true Bitcoin bull market would be if it can manage to make a new all-time high against gold. I mean, you would expect it to do that. right? I mean, so far the high took place in October, November 21. Oh, look, retest. So retested that in December, and now it's lagging behind. So I would expect, I don't know, this is interesting. I mean, we could make the case that that Bitcoin should make any all-time high against gold in this bull market, which it hasn't done so far. Now, if you want, I can go into the correlation thing. But again, just gotta ask me about it because that one it takes time to set it up. That's why I haven't shown it yet. It takes time to set up the chart. So the answer to that. So Perry's saying, well, couldn't you look at it like BTC never actually decouples from liquidity at all, but just sometimes has other forces that overwhelm the coupling, like you explained the ETF battles in 2023. So the question, roughly speaking, Perry, is that it's not actually decoupling. It's just that other forces overwhelm the coupling. No, I think that's exactly what it is. I don't think it's, yeah, I guess decoupling is not the right word. No, I totally see what you're saying. I think it's just the fact that this correlation exists and it's always there, relatively speaking, but sometimes other factors can overwhelm that relationship, and suddenly that correlation with liquidity takes a backseat to other things that are happening. But on the background, the correlation is still there. And I think that's a perfect way to put it. And yes, I think that's what it is. All right. So what's your thought on US gold revaluation soon? My thoughts on that, I haven't actually given it much thought. I don't think it's going to happen anytime soon because that's kind of a default. So that will be a US default. That will be them saying, hey, we're buzzed. We need to print a lot of money. We don't have the means to. We don't have any justification other than, hey, gold is worth $3,500 an ounce, so let's revalue. Do I think eventually it happens? Yeah, I do. In fact, when I got involved in trading, it was not to trade crypto at all because crypto didn't really exist. It was 2009, it was starting. And even when Bitcoin started in 2009, 2010, I was mostly trading gold. And I started at a pretty good time, which is this time. I started trading and this was paper money initially, then it migrated to real money by the time the bull run was ending. And I started, let's say, looking at it, just trying to come up with a trading strategy, very new. I started this trading journey in 2009, so I didn't know anything. At this time, I know nothing. And all I know is I zoom out here and I notice that other than 2008, and I didn't have access to data prior to 2000. I think I was looking at 2004 through the present because this is what I had access to, I think. I had access to the ETF. So I was looking at the ETF and money printing and all that stuff. And as far back as I could see, which was not much, it's 2004, gold was in a bull market. And I thought, okay, well, the reason it's a bull market is only money printing and all that stuff. That's how I rationalized, and I still do, the fact that 2008 was relatively mild for gold versus other things. It was the same in COVID. It was relatively mild for gold, which is quite interesting. It's like crash immune. And so I noticed this pattern, what then became the 20-week cycle for me. And I would just trade all this. I would trade all these these higher highs and higher lows. You can see how regular it is. By 2011, I've been studying trading for a couple of years. I totally saw that high coming. And the reason is because it went parabolic. Now, where am I going with this? Back then in 2010, 2011, 2009, I think some of you might remember that. There was a lot of talk about eventually gold makes its way back into the monetary system and it is revalued by the US government as a means to balance the balance sheet, the national balance sheet. So in other words, the US would say, we owe, what's the national debt right now? Like 35 trillion. We own $35 trillion worth of gold if we rebase it at this number. And it was Jim Sinclair, who I think has passed. It was awesome. Jim Sinclair wrote this newsletter, free newsletter, I don't think he was selling newsletters at all. He owned a mining company. I don't know if you ever heard of him. He was called Mr. Gold. This is one of the first people that I read, and he would talk about Marty Armstrong a lot. That's how I met Marty Armstrong, because Jim Sinclair would talk about him. And he always said that gold, I don't exactly remember how he said it. He had a great way of saying it. He said gold is going to balance the balance sheet of the United States. It's something along those lines. And what he meant, I didn't know what he meant by that. What he meant is that gold would be revalued to balance the books. I don't remember if he meant he was talking about the Fed being bankrupt, which it looks like it might become bankrupt as a result of the interest rate policy, or the Treasury, or something like that. But what these guys were saying is that eventually the powers that be, the ones who pull the strings in the financial system, are going to use gold to balance the, I guess, the Treasury. It's hard to think of these institutions as bankrupt because they print money, so they don't technically go bankrupt. They just debase the currency, which, by the way, they devalue gold, or rather, if they rebase gold, they are debasing the currency. It's just another form of money printing, because the moment they revalue gold, they get to print however many trillions it comes up to be at that point. So let's say gold by then is $5,000 an ounce. They revalue the gold, and then suddenly they can print $20 trillion. And that's how it would be used. I know there's a lot of talk about this, Sung or Perry or any of you guys. I don't know if you want to link to something, because I heard that Treasury Secretary Bessent was talking about that. I don't think any of these guys are going to do it anytime soon, because it would take a crisis for the U.S. to actually pull out that ace from up their sleeves. Like, oh, we got all this gold, and we are valuing it at $35, but actually it's like more like $3,500. So I see that happening at some point, but I'm not sure when. I don't have any opinion as to when that might happen. Beyond that, a lot of the speculation was around, how high is it going to be revalued? Are they going to revalue it are going to mark to market the portfolio of gold, if they still have it? Which I'm not going to go there, but I think they have it, but maybe they don't. In Fort Knox or whatever, that's never been audited. That Elon Musk wanted to audit Fort Knox. It was hilarious. I was like, yeah, I don't think so. I don't think they don't allow these things. So I didn't think he would succeed. Or where was I going with this? So are they going to revalue at market, like mark to market, their gold holdings? If they did this, so if they revalued, I would guess yes, they're gonna mark to market. But what the Jim Sinclairs, I think, were saying is, oh no, they're gonna value it at whatever they think, whatever they want. So they're gonna say it's worth $10,000 an ounce, and this is how much money we have now. I think that's a little bit more out there. Now the reason for that is because, as appealing as that sounds, it's kind of like I said, it's default. The market would see it as a default. The dollar would tank regardless. You don't get to say, I'll just revalue my gold holdings and print all this money and have the market not react. The market is going to react to that. Okay, that's going to result in a massive boost in global liquidity. Bitcoin's gonna go up, the stock market's gonna surge, real estate is gonna go up. Like, we've seen this before. It's COVID on steroids. So, which is why they're not doing it. Because if it was an easy solution to anything, they would do it. But it's like Marty Armstrong once said, and again, I love Marty Armstrong. Before I say that, I love the guy. But he once said, well, the way to solve the sovereign debt, I have the solution. In fact, he called it exactly that. He called it the solution to the debt problem. And I'll just say, I don't agree with that. Who am I to question the great Martin Armstrong? I'm nobody, but that's my opinion. And you guys are here for my opinion anyway. So he said the way to solve it is you take all the national debt and you turn it into these vouchers where you can purchase stock. So essentially, you take all the national debt, all the treasuries outstanding, and instead of paying back in dollars, you're going to get this voucher, and you're going to be able to use this voucher to buy US stocks. And I thought, okay, cool. How is that different from printing the money? Because if I'm given a voucher for $1 trillion, let's say Saudi Arabia, I have $1 trillion worth of vouchers that he said to invest in the United States. Like you can use these vouchers to invest in the United States. Well, that sounds like a lot like money. It sounds a lot like the dollar. The dollar is a voucher that you can use to invest in the United States. And guess what? Because the US has the biggest stock market in the planet, I'm pretty sure I can take those vouchers from Saudi Arabia to Brazil and give them to someone and have them give me goods and services in exchange for these vouchers. So here's the thing. How are those vouchers any different from the US dollar? So what is this man arguing? Well, he's basically saying let's just print the money. That's another, because we were going to do this debate. This is 2018. And I was going to say, because he sent us, me and a friend, he sent us like the solution ahead of time so we could look at it. And my friend and I started debating the idea. And I took the position that that's just money printing because I had the view that the Fed is just going to print. That's how the US will get out of its national debt. Yield curve control and a lot of money printing. They're going to print their way out of this because they always have, they always will. And by they, I don't mean the United States government. I mean all great powers that get into debt will just print it away eventually. So whether it's vouchers, I mean, I'm not saying Marty's wrong. Maybe they do the voucher thing. That will turn into the new dollar, or it will trade in parallel. I'll bet you there's a trading, those vouchers will trade against the US dollar, and it's gonna be close to 1-to-1. It's close, very close to a 1-to-1 relationship. Because the market will rightly see that as money printing. Those are my thoughts on gold revaluation. I think that if they revalue gold, the market will just see it as you're not revaluing gold, you're just printing money and you need an excuse. So like we can point to the year and oh, we're scrapping our budget rules because we have to fight the war with Russia. Yeah, Russia's this big enemy, and we have to print this money to fight the Russians. We want to print €1 trillion, and it's super funny because I think it was a Greek finance minister said, hey, yeah, we need to print money to fight the Russians. We need to build better roads. The guy just wants to build the roads. I mean, that's what it sounds like. It's like, I need 15 billion euros to renew the roads so the tanks can roll over them. But in reality, it's like, I just think they want the 15 billion to do roadworks, and Russia being the enemy is just the excuse du jour. These guys come up with excuses to print. So if they do vouchers in exchange for treasuries, that's an excuse to print. If they revalue gold, that's an excuse to print. So whether they revalue gold or not, I think the bigger question is, how are they going to solve this crisis? They're going to print money. And whether they revalue gold or not, when they print that money, gold's going to go up, Bitcoin's going to go up, stocks are going to go up. It's the same old story. Like these look like different solutions, but actually it's the same thing. It's just money printing with a different name because they always come up with a different name. It's financial engineering and the cheap variety. It's not even the good kind. Anyways, so Perry's saying revaluation could be because of an audit run on the COMEX by demanding actual physical delivery too. Gold bugs have been saying that for years, decades though. Upcoming gold forecast dates. Thanks for the forecast dates, Perry. As far as the comment on the COMEX and revaluation, so that one I believe a bit more. Not that I don't believe in revaluation, I do. I just think it's money printing by a different name. Now, there's the issue of the massive short position that JP Morgan and others have on gold. Now, that one is quite interesting. My view on that is we might be seeing it now. So the reason gold may be so strong is because there's a lot of paper gold sold out there. And there's a lot of people who think they own gold, but actually what they own is a futures contract that they keep rolling over, or they own the GLD ETF, or they own gold through some paper form, and there's not enough gold. And I believe this is referred to as unallocated gold bars. Unallocated means it could be my gold bar, it could be Perry's gold bar, and Marcus's gold bar all at the same time. So we all the three of us think we have an ounce of gold, and in fact, only one of us does. Or another way of putting it, there's actually only a third of an ounce for each of us. So there's not enough gold. Now that I believe a lot more. And the reason I say that is because, again, during COVID, we noticed that silver was trading. So let me pull up a chart of silver. I don't know what the ticker is for silver here. I don't look at silver. I know somebody asked me about it a while back, and I was like, yeah, I don't look at it. But let's look at it for now, because there's a during COVID. So silver went to 12, and when it was falling here around March, this friend of mine, German, with whom I met him, and we're friends, and then he's friends with Marty Armstrong. That's how I know Marty. So he calls me in March, mid-March. I don't remember exactly when it was. I think silver was trading for 15. And he calls me up and he says, hey, no one is selling silver for less than $20. No one. I cannot find silver for less than $20. And I say, well, that's fine. I think I can buy a futures contract for 12, 13. And like, can you just call the dealer and say you'll deliver 5,000 ounces of silver, and we can just buy it? Well, I'll buy as much as I can, and then we'll take delivery. We'll take delivery of the silver, we'll store it, and then we'll ship it, and we'll make 50%. So that's what we wanted to do. I was like, okay, that's true. And he knows the market. He's a gold bug. He's been involved in gold forever. He said, no, it's not selling for less than $20. So you can't find it anywhere. I was like, well, that's interesting. Okay, let me buy some silver. So I reached out to my broker. It's a retail broker. And I said, hey, I want to buy a couple of silver contracts, and I want to take delivery. What are my options? And they go, no, we don't do delivery. We'll close down your contract. If you choose to hold to expiration, we'll close it for you. We do not take delivery. It turns out this was a problem at the time. Silver was not being delivered. It was hard to get the actual physical. So it got me thinking about all these conspiracy theories. I was thinking, well, wait a minute. I mean, if silver is trading for $13, but I can't get my hands on real silver for $13, is silver trading for $13? Or it's just a fake price? And that's when, all the years of listening to gold bugs just hit me all at once. I was like, right, that's what they mean by paper market. That's a paper market. It's fake. It's not real. If you want real silver, you pay $20. It didn't drop to, what was it, 12? It never dropped to 12. The actual physical metal never traded for that price. I mean, I'm sure somebody's able, with contacts and whatever, is able to take delivery, but most of us can't. So we're trading SLV ETFs like it's real silver. It's not. And if enough of us wanted to take delivery of the gold or the silver, let me go back to gold, JP Morgan and the like would say, yeah, we don't actually have it. Here's some cash. You can buy it somewhere else. And I think that's in the contracts. So the exchanges don't necessarily, they can settle in cash. They don't necessarily have to give you physical. They can settle in cash. And if they can settle in cash, then that means the gold doesn't have to exist. Which means that BRICS nations like China, maybe Russia, they might be buying gold in the West because they're just calling the shorts. They're calling the bluff. They're saying, we know you don't have the gold, so we want ours right now. And they keep bidding the price up. And this ties into why we may not be seeing an 18-month correction in gold. The reason we're not seeing it could be because there's huge demand for physical metal that's holding the price up. So I think there's a bit of that. Gold market is super interesting, far more so than Bitcoin. If it was more volatile, I would just trade gold all day. But yeah, the money is in crypto. All right, let's keep going here. And by the way, I have to go at 12:30 because my daughter's coming, and I'm all alone here, so I gotta take care of her. Just giving you the heads up. And Perry saying it's funny when you say a concept is a bit out there, coming from a guy who built a financial forecast model based on cosmic timings of all things. I mean that in the best way, of course. Yeah, no, I know. I just, hey, I think the cosmic thing, the cosmic timing has proven itself at this point. It's pretty accurate. So, and I know it's out there. It's totally out there. I just tried for years to come up with a good way to forecast future price action. I had nothing. I had to try this cosmic thing because again, one of the first people that I studied was this guy Ray Merriman. Ray Merriman, back in 2012, I read all his books, and he swore by this method of using cosmic timings to forecast things. Now, personally, when I read the books, I wasn't sold on it. I was like, yeah, I think it's okay. Yeah, it's kind of useful, but not really. I really liked the whole cycle thing. The cycle thing I loved. I didn't think it was quite there, which is why when I discovered Hearst, I was like, okay, that's it. That's what I like. And the cosmic timing, I left it aside. I decided that I had no use for it, that I didn't need it. It wasn't important. But then it come AI actually come up with a pretty complicated, it's not a complicated algorithm, but it was complicated to do like coding wise. The idea is very simple. You take all the 80-day highs, all the 80-day lows, and you see what the planets are doing and their relationships. And then you see if there's just run a simple search to see if there's any correlation there. You just correlate them. It's like 90, you try to see if there's a correlation between 90-degree angles between Jupiter and Mars with 80-day highs and lows. That sounds ridiculous, right? Okay, it sounds ridiculous. So if it is ridiculous, there should be no correlation. Well, it turns out there's a very strong correlation, very strong. And then you take out the best correlates, you take those, because there's like 1,000 or 2,000 different possibilities, like angles and pairs. It's just endless. And you take the top 50 of those and you try to see when those are going to take place in the future. And you look for clusters. And I just tried it out. I tried it out in 2024. It was magic. It worked incredibly. It just far exceeded my expectations. I was like, well, there's definite. Now I can see why Ray likes this so much. He swears by this. It does work. I just thought it was too slow the way he did it, or it was not detailed enough, or honestly, it required too much work. That's kind of the problem. It requires too much work. You have to sit down and write all these things, and then you're gonna be off anyways. And so, but with an algorithm, it took it took a year to write the algorithm. But once I wrote it, I just hit run. It takes 30, 40 minutes, and then it comes out with dates. So yeah, but yeah, it's out there too. It's totally out there. And if somebody thinks, and by the way, I have colleagues at the company at Wise who think I'm totally crazy. I I was even called a crackpot econometrician the other day by by one of the copy guys. He's like, "You're a crackpot." I'm like, I'll wear that like a badge of honor. I'm definitely a crackpot because I'm willing to try these things that for most people don't try because they don't think they make sense. But they do make sense to me. They do. I mean, and I also knew from 2012 that this guy in the 80s had done this work and it seemed to work. And then I watched that Y-Files video, this guy Nelson in the 40s doing something that I really liked because it was more computational. The way he did it, his approach was far more scientific, a lot more methodical. And I said, okay, I think I can copy that. So the way Ray does it, it was too manual for me. It was more of an art than a science. But the way Nelson was doing it was very scientific, kind of like Hearst. So I thought, okay, that I'm willing to try because if it doesn't work, it doesn't work. And turns out it works. So. All right, so Perrin says, yes, spot price of metals can be way different than the real physical price because they add any premium they want on a physical store, which was literally as high as 50% at the time, silver 14, but 7, yeah, it was 50%. Remember that. The number is oh, we can make 50%. And I'm all about that. I love delta neutral strategies. Delta neutral is my bread and butter. I mean, I do speculate on the price of Bitcoin and what have you, but like I put a gun to my head, what is the best strategy in crypto right now? It's gotta be CRV. It's gotta be the CRV bond trading thing, liquid locker thing, because That's delta neutral. You know how much you're gonna make. You don't know when, but you know you're gonna get paid. And I love those trades. Whereas if you buy Bitcoin, you don't know if you're gonna get paid or not. You have no way of knowing. You can speculate, which is why they call it speculation. But if I buy those liquid lockers on CRV and I put a hedge on and I manage my hedge, I'm gonna get paid. That's actually my preferred strategy. So $14 silver and then selling it in Germany for $21, I'll do that all day. Like I'll put all my money on a trade like that. I like that more. I don't like to speculate. So I speculate, but I don't like it. If I know how much I'm going to make, I'll do that all day. I just noticed that because another confession I have to make. I'm not proud of this, but back in 2020, so in March of 2020, I'm doing mostly delta neutral strategies in crypto, it wasn't the golden age of delta neutral in crypto. That was 2014, but it was still good in 2020, especially with FTX, which was a total mess. So I was doing a lot of buying here, selling there, arbitrage, yield farming. Yield farming came later in DeFi summer. Before then, we had just arbitrage. You could just buy spot, lever it up on DYDX, just borrow USDC, buy ETH, and then sell ETH futures. Perpetual swaps futures depended. I had a whole dashboard with different yields, different implied interest rates. And I would just do this. And I had the bulk of my money on that. So this bull market comes and I'm patting myself in the back. I'm making so much money doing arbitrage. Making a lot of money doing arbitrage. And of course I have some small stash of crypto assets. I have ETH and Bitcoin, a little bit, not much. I had some Cardano too. And as this bull market is taking place, by the time we get to May, I just look at all the money I made doing arbitrage, which is a ton of work. And my crypto bags, which were once very tiny, it was like 10 or 20%, now are matching my arbitrage fund. So my arbitrage effort, which is a lot of effort to spot the opportunity, to capitalize on it, now it's being matched by crypto. And crypto was no work at all for me. I just bought it and I held on to it. So when we come to the new bull market, I said to myself, I love trading arbitrage and I love yield farming, but in a crypto bull market, nothing beats just long crypto. Nothing beats that. It's very hard to beat. I think I did 150% doing arbitrage in 2021 alone. And it was something along those lines also in 2020. That was peanuts in comparison with what I could have made just holding ETH. So I was very mad at myself. And when the new bull market came in 23, actually in 22, in 22, you cash out of everything or most things, even arbitrage was dead at the time. So what I kept telling myself is it doesn't matter if I underperform during a bull market because I'm going to make a lot of money in a bear market too because I'm delta neutral. I was wrong. Delta neutral strategies collapse in a bear market. Why? Because no one's borrowing money. No one's borrowing to buy crypto futures. So those premiums contract, they collapse. So I went from making 150% a year to 10% a year. And I was like, well, that didn't work out as I expected. I thought I was going to be making 100% a year, or maybe 50%. I thought it was going to be 30%. In a bear market, no, it's 10 or 5. And so I learned the lesson. I was like, well, okay, so I underperform on the way up. And sure, delta neutral makes money in a bear market, but it doesn't make 30%. It doesn't make 40%. It makes 10. It makes 5. What's the point? So the best thing is what I'm doing now is I have the long crypto stuff, and then I just borrow money and I do my delta, and it keeps me busy with the delta neutral. But to be honest, nothing beats just buying crypto. That's the best. Even in this bull market, which has been pretty weak. So Sung is saying their valuation will skyrocket US bond yields. I know Trump doesn't want that. So the bond market is not a free market. This is my take. These are rates. So you see, the market is moving to pricing lower rates. I wonder what Jay Powell said. We all gotta go and look what he said, because I don't think he's saying I'm gonna cut rates by 300 basis points. but maybe I'm wrong. Um, so this is not a free market. This is not a free market. If rates go too high, the Fed steps in and call it a fucking whatever. They can call it whatever. They can revalue gold. They can put a lead on rates, just saying we're not going to do that. They did this in the 40s, by the way. It was the stated policy of the United States was to use the Federal Reserve to suppress rates and to specifically hold them below the inflation numbers to just print or debase the currency, debase the debt away. So how the US got out of its World War II post-war debt is they just held bond yields down while inflation kept going up, and eventually the purchasing power of the currency falls to the point where you don't owe any money anymore. So that's what they did in the 1940s. They're not doing that now, but they're probably going to start. That's called yield curve control. The guy to follow on this is Luke Gromen, the bald guy. He's awesome, and he's always saying it's yield curve control. It's coming. And I think the reason he's saying it's coming is there's no choice. Of course, it's coming. There's no choice. There's no alternative to this. You have to hold the rates down. If you don't hold the rates down, eventually interest payments are going to devour the entire federal budget. You can't have that. And so the only way to bail out the US government now is to have slow control inflation, which is not what the Fed is doing today. I think today they're holding rates above inflation, which is why rates are going to come down. This is how you put two and two together. It's like, are rates going to come down? Absolutely. They're going to come down. Are they going to come down now in September to the point where the market is going to be satisfied? No, I don't think so. I think we're going to have to wait for Jay's replacement. Jay Powell's going to go. He's going to be the guy who killed inflation. And then the next guy is going to come in and inherit the problem, which again, I know it's a bit of a cynical view, but he doesn't have to do this. And he knows he's taking a lot of risks if he's cutting rates now because inflation's coming back up. I just saw it. It was about 3% again. Like the inflation is not coming down. It's not coming down. So he should not be cutting. He may cut once and be done, and he's out by February, I think. So he's out in a few months anyways. He doesn't care. That's just my take. All right, so Perry's saying it's interesting how often we have double tops or double bottoms. Is that because the smaller cycle is pulling harder in the middle of the larger cycle? That's exactly what it is, Perry. That's exactly what it is. So all of these double tops and bottoms, you could consider this a double top or a double bottom. Now watch what I do because this gets interesting. Let's do a filter. Well, let's do this. So we turn this into an 80-day cycle filter. Well, this is not a good example. Let me find a good example. Oh, this is a good example. This is a good example. So notice where the, can I? No, I can't do that. So notice where the high in the filter is. It's right on, it's right in the middle of these two. It's right in the middle of these two. So a double top is oftentimes a larger cycle is topping out and it's going flat. And so the only thing you see while the bigger cycle is flat is the smaller cycle. So from a cycle perspective, what you're looking at here in this section here, you're just seeing the 20-day cycle. Because the 80-day cycle, the larger cycle, is flattening ahead of going down. That's what's happening. And it's not just you see it if you just mathematically add up sine waves and you line them up the right way, just following the Hurst principle of all the lows being aligned when they can, you're going to notice this pattern. You're going to notice that at the top, you get a double top. So that's what's happening. It's just that there's a point when the cycle flattens, the big cycle flattens, all you can see is the smaller cycles, and those smaller cycles are just hitting the same level, which is why you keep seeing these again and again and again. You see these a lot. I wonder if we see it with the 320-day cycle here. We probably do. Boom. There we go. This cycle is not perfect. Sorry, the filter is not perfect. So you can kind of see that there's a low here. And there's 3 bottoms kind of at the same level. So what's happening here from a theoretical perspective, if you accept the model, of course, is that the 320 just flattened. This one flat because it's turning up. Because of that, all you can see is these flat 80-day cycles. Because it's the 320 is doing this, then it goes sideways, then it goes up. And the reason it takes a lot longer is because this is a longer cycle. So this moment in time, you're just seeing an 80-day cycle, an 80-day wave. That's all you're seeing. So yeah, that happens a lot. It's a pretty common pattern. I thought it was fascinating when I discovered that. I was like, oh wow. So that explains the double top, double bottom. It's literally a cycle turning down or turning up. It's very interesting. All right. Do you have time to compare a couple multiple VTLs and FLDs? 20-day, 80-day, 240-day, 480-day, same as 16-month. I do have time for that, Perry. It's just if the bell rings, I gotta get out. But let's get into it. So you want me to do all these, and these are VTLs and FLDs. All right, let me see. So what are you trying to say? I'm assuming you want me to go to the present day, right? Just a couple. So present day Bitcoin. I'm assuming yes. Present day Bitcoin. Okay. So VTLs and FLDs. Okay. Let's do 20, 80, and 320. Is that good? 320 is between 240 and 480. So it's right in between. So it's like 2 birds, 1 stone. Yeah, this is the bread and butter of the course. All right. Yeah, this is like for all the forecasting and liquidity and all that stuff, that is the thing you need to know. It's like filters, FLD. That'll make they turn me into a profitable trader. And again, I'm not the best directional trader. I'm much better at delta neutral stuff. If I'm any good at trading directionally, it's because of cycles. Just shout out to the liquidity pools I launched. They are outperforming Bitcoin. Why? Because I removed myself. So now this guy who sometimes doubts his own models is out of the picture, and it's a bot that's trading, and the results are pretty good. So I think it will continue to outperform Bitcoin. So in other words, the cycle trading, pure cycle, no emotions in between, just pure cycles, it works. It does work. It does make money. Okay, so that's one, and this is this, and let's do VTLs because we don't have flows. So I'm gonna paint them so the VTLs and the FLDs match their color. So blue for the 80-day VTL, black for the 320. There you go. That's roughly where it is. I don't know why I don't have this black line because I always have it. I figured it was so far away from price that it didn't matter. And 20-day VTL was just cross. I don't know, where is that one? I think it's right there. That one was crossed. Interesting how they line up with the 80-day, isn't it? This red line is the 20 VTL. Okay, so red is 20 days VTL FLD. Blue is 80-day VTL FLD. Black 320-day VTL and FLD. There we go. Look at how price action bounces off the black VTL. It's fascinating. So it's not bouncing off it. I'm actually drawing it off of it. Although I think it's the same VTL that was drawn here. So if you do this one, no, it's close, but it's not the same. I made it bounce there because this is a 16-month low, 480 to 40. Again, I'm taking the average of the two. I think that's the right cycle. It's 320. It's the average between 240 and 480. Or is it? I think it is. Look at off the black. Oh, yeah, I see what you're saying. No. Listen, this black FLD is very useful. It's very useful to have if you don't have a VTL. Now crossing below it is not necessarily a bad thing. You saw it here. This crosses below it. It does point to lows. So if you're looking for a low, that usually tells you that that's where the low is. Now remember that's in lesson 1, I think, when I teach. No, that's in lesson 2, FLDs. When I say in order to confirm a cycle, in theory, the prices need to cross below the FLD and back above. Well, that's true of the 320-day FLD for Bitcoin. I mean, it's true every time. Test or cross. It was tested in April. It was crossed here. It was crossed here. And it was crossed here also. And go back. And it keeps being crossed. It was crossed here. This is super noisy. This is part of the reason I said that pre-COVID, the 320 low should have been in December, but then COVID just derailed the cycle picture, just totally distorted the cycle picture. Now, why am I saying that? I'm saying that because you have this 80-day VTL crossing over, and these rarely fail. And as of this crossing over, you would say, okay, the correction's done. It wasn't done. Prices just crashed. Anyways, I'm gonna go back to the present because I don't have a lot of time here. What I would say here is if you can draw the black line, so the black VTL, the 320 VTL, you should stick to that one, unless you're having trouble facing the 320 cycle, in which case you might want to use the FLE just to know where it is. Now they tend to be pretty obvious. By that I mean that in this bull market, all 320-day corrections, all of them, where they took place after an 80-day VTL crossover, but not just any VTL crossover from a double top or a lower high, all of them. So you can wait for prices to test the black line, or you can just notice the VTL was crossed here. And when was it crossed? I think it was early February. Another way of saying is, by the way, I don't usually short crypto. I don't think you can make a lot of money shorting crypto, but one strategy could be, okay, crosses the VTL, I go short, and I buy as soon as this is tested, because that's when we're hitting the 60-month or the 320-day cycle low. Could be a viable strategy. I actually haven't been able to develop good trading strategies on the short side, because I tend to do a lot of breakout stuff. The breakout strategies. I do use FLDs and VTLs to enter trades. There's actually some pretty good strategies you can do there. If you're interested in what that is, if you go to the vaults on the Discord, the cycle trading, I don't remember what it's called. It's like cycle trading 20-day, 2 out of 2. That one uses FLDs and VTLs to enter and exit trades. It doesn't use breakouts. It doesn't use anything, which means it works something like this. So first, it waits for prices to cross below the blue line, for example, the blue FLD, the 80-day FLD, and then it draws the 20-day VTL like that, and it buys that breakout. So, or that crossing over. So it buys after crossing the VTL, not the breakout, not the 80-day cycle high, the VTL. And I wrote an algorithm that checks to see if you should use only VTLs or VTLs for entry and FLDs for exit, or only FLDs. It just tries all combinations. There's like in total, there's 1,024 different combinations, and it picks the best. So I'm actually proud of that one. It's a pretty, I mean, I never had strategies that used VTLs and FLDs, which they feel like the best way to enter a trade, right? Like what's the best time to enter a long Bitcoin position? I mean, you would think a pretty good way of doing it is, and I teach this in the Bitcoin lesson, I think it's lesson 8. The best way is, okay, let's wait for the FLD to be crossed. We wait for the 80-day FLD to be crossed, and then we start drawing the 20-day VTL. And when it crosses that, you buy it. Well, I wrote an algorithm. Oh, wait, here. So I wrote an algorithm that checks to see which is the right combination. Should you wait for the VTL to be crossed, or should you wait for the FLD to be crossed? And if you wait for the FLD or the VTL, should you use the VTL to enter, or should you use the FLD? So it checks all these combinations. That alone is like 8 combinations or something. But then there's a lot more. It takes larger cycles into account. Like, what if prices are below the 320-day VTL? Should we use this strategy at all? Like, it's stuff like that. So it uses, like, I think it's 1024. I think it's the number of combinations, which is like 2 to the power of the number of indicators. I think it's 10. There's 2 to the power of 10. There's a lot of calculations go into that. And so yeah, this is a very, I'm still exploring strategies that use, I see you using Wix VTLs. You're Perry saying your chart is starting to look as busy as mine. Yeah, no, I know. When I do these AMAs, I have to like clean it all up later. I like to keep the charts clean because I like to see what prices are doing. Like, for example, I like to see Bitcoin rally, but kind of fade. And saying, when did it fade? Oh, it crossed the VTL. So I use the low wick. I'm using the low wick VTL for the 80-day because, I mean, we already know that's the one that worked. So, but for the most part, I use closes just intuitively. I just draw it from the close. Part of the reason I said I don't think it makes a big difference if you use lows, the wicks or the bodies, is because I have tested these. Like, my trading strategies, I don't launch a trading strategy per se. What I do is I create parameters. Like, for example, I want to buy whether markets break above a cycle high, or they break above an FLD, or they break above a VTL. And I trade all these combinations, and then I pick the one that's the best approach. And I just think that if it made a difference, it would show. Although, to be honest, in order to know, there's a Steelman argument is like, I should actually check to see wick VTLs versus body VTLs and do a study. I'll do it. But I am busy with other things. I actually have to fix other things in the algorithms, and I haven't had time. So, oh, it's very sane. And with this, I'm gonna wrap. Thank you all for joining. But I'll read your latest comments. It's just astounding to me how the math and the FLDs work, because it's just a moving average, but then shifted into the future, and yet price action will somehow nearly exactly touch it. A shifted derivative line is just magic to me. Yeah, I fell in love with these two, Perry, when I discovered them. The reason I'm more fascinated with like global liquidity, for example, or my forecasting model, is because I have been using, like, of course, you guys have met me recently, but I've been using these FLDs for years. I've been using them for 13 years. This is not new to me. And to my knowledge, I'm the only one using these. Like, a lot of people are using, in closing here, I wanted to show you something, Perry, which I showed you before, but I think you should watch it again. This is, let me bring up a Hurst FLD. So Hurst FLD is this. This is the red line. That is a Hurst 80-day FLD. It's very simple. There is no moving average, and all you have to do is push the line forward by half a cycle, half a duration. And notice a matching, because the FLD that I use is a filter of that Hurst FLD. It is a filter of it. And there's just a lot more noise in the Hurst version. There's a lot more noise. Yeah, I don't know if I can show you a good one here, but let's look at this. Like, what is this? There's just more noise. So I prefer to use the clean line. So yeah, I've been using that since 2012. That's one of the first things I figured out. The model that I use, computer model that I use, it was first like written on paper. There was no computer model. It was just a bunch of rules written on paper, which is really what code is. It's just rules written somewhere, and then a computer just goes through the instructions. So it's just rules written on paper, and I was using just on paper. Hey, where'd the VTL go? Oh, I need to put it back on. All right. Thanks again, Juan. Got to run. Try to enjoy Paris, and good luck with the move to Colombia, amigo. Thanks, Marcos. I think you're gone. Oh, you're still here. So thanks, Marcos. Thanks, everybody else. Thanks, Barry, for the questions. Thanks, Soon, for the questions. I'll see you guys on Discord, and got to run. I think my daughter's coming anytime soon here. So thanks for joining, as always. And again, I'll see you on Discord. Ciao, everybody. Cheers, all.